Hello, welcome back. And this is SeeWing Yee from the Yee Real Estate Network. And today I'm going to go over a very deep dive on this duplex property. It's a new construction co-living duplex rent by the room model. So the purpose of this evaluation is to help you to understand real estate investing better, how to analyze the numbers, right? How to underwrite the property. I'm going to share with you some very simple, if you numerical formulas. Once you learn this high conceptual numerical analysis of any income property, you can walk away after this video with a much more confidence, much more informed, and much more inspired to uh to uh to do this kind of a deal, right? Because what I found over the years, and I've been doing this for more than 20 years, building my own real estate portfolio, achieving financial freedom, and also helping and coach uh, hundreds and hundreds of real estate investors across the country to buy turnkey cash flow new construction properties in different part of the country uh, with uh, uh, with property management, the whole 9 yards. So it's just hands off, hands off type of concept. So which is so inspiring. All right. So without further ado, let me share my screen. And here we are. This is one of the investment model that we're sharing is a co-living rent by the room model, which is one of the, if not the fastest growing real estate asset class in the country, in my humble opinion. So the this model, we have other investment model, but today we can talk about the duplex, 14 bedroom and 14 private en suite bathrooms, 1 bedroom to 1 private bathroom ratio, and we rent to a workforce housing. Okay. Yeah. So anyway, so this is a starting point for this property, 600,000. We put anywhere from 20 to 25% down payment using the DSCR loan. So at the end of the day, the cash flow is extremely high, as you can see, $5,000. But we're gonna do a deep dive. Don't worry about that. So this is a beautiful property located in Jacksonville, Florida. Very, very nicely done. It's a ground up, purpose-built co-living rent by the room investment model, which is we've been having a lot of success doing this. So this is part of the numerical due diligence. So one of the pro forma we'd like to share with you is the gross rent. You know, we we obtain approximately $1,000 per month per member tenant through the past split marketing. Okay, per month. So 14 rooms equals almost $14,000 gross rent. We pay as host owner of this type of property. You pay past split, which is the marketing tech platform, 8% of your gross rent to so they can pre-screen the tenant for you and all that, and they collect the rent, everything on your behalf. And in addition, you're going to pay the co-living property management fee of another 8% of the gross rent. So the rest of these numbers are very, very, very simple. I'm not going to go over spend too much time on this pro forma. You just on your own, once you replay the video, you can dissect this information in much more detail on your own, right? So pause a screenshot and learn it. But this is the pro forma I want to share with you, okay? So which is very, very important. Okay, we have this is I created this through propertytracker.com, which you can obtain a free account. Property Tracker, they will, just help you run through the numbers. It's a very, very informative. You can do a free trial of this Property Tracker, so you can crunch all the numbers. It's not that hard. It's not a rocket science. This is a basic math, right? We're talking like even junior high school math, if you will. So, do not fear math, because it's important. Once you learn this, you can be a much better real estate investor. So at the end of the day, what you're going to do is here's in fact, a better way for me to share this with you is to use this particular interactive software property tracker using this method better. Okay, so all right, so we go. $650,000 duplex, 14 bedroom, 14 bath. You put your down payment, which is 20% down payment. We have a builder's rate buy down, which is amazing. You're not gonna get this kind of loan anywhere. DSCR, debt service coverage ratio, no W-2 income required, documentation, no federal tax return required. The lender will underwrite the property. Okay, if the property underwrite at for example 1% debt to ratio, then you qualify, right, to get this loan at a very favorable rate. Now by connecting with us, by buying property through our network, this co-living property for $650K, you get the favorable builder incentive of buying down the rate of 5.5%. Normally, right, the prevailing mortgage rate right now nationwide is around 6.7%. That's for owner occupied rate. But as an investor, you usually pay higher, right? Usually like 50 basis point higher than the prevailing owner occupied investment rate of 6.7% per Mortgage News Daily. As of today, which is the August, what's today's date? It's August 14th, 2026, as I'm recording this video. So normally on any kind of investment loan, DSCR or full doc investment loan, Fannie Mae lending guideline, full doc loan, normally you have to pay 7.5% or even 8% loan. In this case scenario, that's the value of connecting through our network. You're getting an amazing 5.5%. The difference between 5.5% versus a 7.5% to 8% a 30-year fixed rate loan on an investment loan could be a whopping $500 more monthly cash flow by getting this rate. That's why your monthly mortgage is your monthly cash flow is almost $5,000. But I'll go over that a little bit later. So the key metric you need to understand is again, the debt coverage ratio is how many times your income, as you can see right here, that cover, DCR, how many times your income covers the mortgage. Above 1.0 means income exceeds the payment. Okay, so your net operating income divided by the monthly mortgage payment, as you can see right here, right? So this is 2.67%, this particular property. So you're way over the 1.0 threshold. So DSCR lender, they love you. They love to underwrite this property. That's why you're getting a very favorable mortgage rate. So this another scenario is what I mean by capitalization rate. The benchmark capitalization rate for a traditional long-term rental is normally around 5% cap rate. But in this particular unique investment model, the co-living rent by the room model, in this situation, you get a whopping 14.6% cap rate. So the cap rate is how you compare the yield, the annual yield without leverage, without a mortgage. So how do you calculate this is as you can see right here, as you can see, the definition on this software give that to you. So capitalization rate is a quick way to compare similar properties. It's annual net operating income divided by the purchase price. Let's go through let's solve this problem. The annual net operating income. So how do you solve for the net operating income? The net operating income is down here, right? Which is right down here, which is the monthly $78.91, annual 94,688. That's net operating income. How we derive at this number? We look at the gross operating income. Your gross rent minus your vacancy loss, which is the vacancy is the 10%. We put 10% vacancy. So we project your 14 room, 14 bathrooms will have a 10% vacancy rate at any given time. So this is a very realistic projection. So your gross monthly rent minus the vacancy loss equals net operating income monthly of 12,600. Then we minus your typical taxes, insurance, property management fee. You pay 8% to pass split for the marketing fee and 8% for the co-living property manager, another 8% for the property management and everything else, which is total 2016. Then the typical maintenance per month, right? Around 560 per month. And the utility, you as a landlord host, you pay for the utilities, the internet, the electric, the water, and the garbage pickup, those kind of things, which is approximately $1,000. So the operating expenses is 4,709. So operating income minus operating minus operating expenses equal net operating income. So divided by 12 months equals annual net operating income of 94,688. You divide that by the purchase price of 650K equal your capitalization rate. Okay, does it make sense? So again, this number, which is again 14.6%, is very, very high. Based on comparable, it's like a commercial rate calculation, if you will, without a mortgage, without leveraging. So this is another important metric, cash on cash return, which is 35%. Now the benchmark cash on cash return is probably around 6 to 8% on a traditional long-term rental, right? We're not talking about traditional long-term rental. We're talking about, a true co-living property, which will give you a lot more returns. So that's why we love this new asset class. You rent by the room business model, co-living, using pass split and everything else. All right. So cash on cash return means what? See the definition? It shows how hard your money is working for you. It's annual cash flow divided by the cash invested, which is your down payment and closing costs, right? So how we came up with 35%, which is very, very high cash and cash return. So you look at the monthly cash flow, right? See, your net operating income is 7891. You minus the mortgage payment, 2953. The mortgage payment is based on 5.5% 30-year fixed rate mortgage, DSCR loan. And your monthly amount you pay 2952, which is right here. So your net operating income minus your mortgage monthly equals net monthly cash flow was $4,938, right? You multiply by 12 months. So at the end of the first year, your annual net cash flow after all the deductions is 59,258, which is huge chunk of money, right? Do you agree? Right? So how do you solve for cash on cash return? Is your annual net cash flow 59,258 divided by the amount invested, which is your down payment up here, right? Your down payment you pay your 20%. Normally, when you buy a duplex or higher, you need to pay 25% down payment per the Fannie Mae lending guidelines. But we're not using Fannie Mae lending guidelines. We're using a no doc, no tax return, no W-2 DSCR loan, which is very, very popular among real estate investors these days. I'm venturing to guess that the DSCR loan they're around is comprised of maybe 30% of all the investment loans out there across the country, right? Full doc loan is very, very popular, right? You submit all your paperwork with the Fannie Mae lending guideline qualification. You get slightly higher, lower interest rate with the full doc Fannie Mae loan, but you're using a DSCR loan, which is very competitive interest rate versus the Fannie Mae full doc loan loans. But in this case, because we have a unique builder's incentive, buy down the rate to 5.5%, 30-year fixed on a DSCR loan, which is absolutely crazy how enticing this this loan rate is. So therefore, your annual net cash flow is $59,258 divided by your down payment right here with $171,000. So equals 35% cash on cash return at the end of the first year. And what's the key about it is, so 35% represent 1/3. If the first year you get 35% cash on cash return of your down payment, how many more years giving the similar number down the road before you can recoup all your down payment? Simple calculation, simple math. 2 more years, 35% cash on cash return the first year, 35% second year, which is 70%, and 30 to 35% the third year. At the end of the third year, 100% cash on cash return are used to pay it off from your down payment. So everything else is gravy, meaning beyond the third year, you already recoup 100% of your down payment at the end of the 3 year based on the cash and cash return scenario. Then the rest of the rest of the ownership you have on this great duplex co-living property going to perform very, very high. Your return in the next 5, 10, 15 total years, if you keep this property, which I don't see any reason why not, you should not be keeping this property for the long term. You know, you're going to earn some amazing multiple returns. All right. So we just finished cash on cash return. And finally, another important metric is how do you calculate for the total return? Okay. The cash flow is just one component of your investment, right? It's not the only one, in case you don't know that, because, you know, because rental property is one of the most attractive asset class in the world, in the country, right? It's a multi-dimensional real estate asset class because there are many ways to make money other than cash flow. You make money with tax benefits. You make money with appreciation growth. You make money with debt pay down by your tenant. You make money. We're going to incorporate a couple of more metrics that you may not have understand from your past investing life. We can talk about the inflation-induced debt destruction, okay? And it'll give you even more higher return. So let's continue. All right, so let's solve for return on investment, ROI, at the end of the first year. The end of the first year of ownership is 54%, right? How do you calculate this 54%? Well, let's show the calculation. Let's go over the definition of your initial ROI right here. ROI right here is return on investment at the end of the first year is total returns as a percent of what you invested. We also show versions that include inflation-induced debt destruction, IIDD, and tax benefit. Okay. Hold your thought. Okay, there's a lot more to this than it meets the eye. All right. So let's solve for the 50%. Wow, how am I only in 1 year? I'm making 54% return on my investment. So the metric is your investment is your down payment, right? $171,000 is your down payment of, in this case, 20% plus closing costs, which is $10,500, which another 30, which is the 20% or more, 650 is $130,000. That's your down payment. Closing cost is about $10,500, and then this $30,000 is your furnishing package. When you close escrow, you have to pay to furnish each room. You have to furnish for the, of course, our team will help you with the furnishing package. But what does that mean? You have to hook up the internet for each room, the utilities, the water, the electric, you have to buy the bed, the table, the lamp, the chair, right? And your large refrigerator in the kitchen, and your table in the kitchen, and what else? And a mini fridge on each of the rooms, each of the 14 rooms, right? You before you pass click and promote your property, you need to close escrow first, of course, and then we help you buy the furnishing, and that itself will cost around $30,000. It costs maybe a little bit more than $2,000, as you can see, right? $30,000 divided by 14 rooms, right? Take a little bit more than $2,000 to furnish each room for the workforce tenant, okay, to occupy each room before pass split start to market your property. Does it make sense? All right, so let me see. So the 54%, how we solve for that? So as you can see, right? So very, very simple. How we solve for that is we solve for that by looking at your net operating income minus your mortgage equal your monthly cash flows 4938 plus you get some economic benefit from principal reduction, principal pay down. Although the initial the first 2/3 of the life of the loan is interest only, right? Only the last 1/3 of the life of the loan is principal, but you still get some principal reduction initially, albeit small, right? Most of it is in the early years of the loan. Most of it is interest, but you still get a little bit of principal pay down by the rent you collect by the tenant. So in this case, monthly we calculate it as approximately principal pay down equals on $584 per month. And per year is $7,005, right? So the two calculation, you add the monthly net cash flow plus principal reduction, and this terminology most of you have not heard of it. It's inflation induced debt destruction. What does that mean? It's a trademark by Jason Hartman, permission to use with attribution. Okay, as inflation happens, the real value of your loan balance goes down. So inflation-induced debt destruction is IIDD as the abbreviation, is a better metric. Is a projected inflation rate as a percentage of the total loan amount. So the total loan amount is multiplied by the projected inflation rate equals the economic number that we're gonna put down on here, right? How do you solve for that? See, on this software, Property Tracker, our government CPI inflation rate for July 2026 is 3.3%. All right, so bear with me. 3.3% multiplied by the loan balance, which is right here, $520,000, right? So inflation is helping you pay down your debt. Okay, so that 3.3% multiplied by 520K equals the annual economic benefit is a profit of 17,160 divided by 12 months on a monthly is 1430. Okay, all right. So one more calculation. So we factor in, we project the annual appreciation of how much on this particular property. The annual appreciation we projected. Where is it? Oh, you're right here. Projected appreciation rate, which is 4%. Pretty historically correct. It's just a projection. So annual projection 4% at the end of the first year, 4% multiplied by $650,000 property, right? In this case, equal the first year on paper, the appreciation is 26,000. Simple math, right? And so monthly is 2,167. So what we do is we add up your annual cash flow, we add the principal reduction, we add the inflation-induced debt destruction of this amount, and the first year appreciation equals gross equity income was 109,423. You divide that by what? You divide that by your down payment of $171,000 equals at the end of the first year return on investment with the inflation-induced debt destruction, which is 10% higher than the traditional total ROI at the end of the first year, which is 64%. Okay, you guys get that? I'm trying to be as simplistic as possible. I'm trying to be present this in layman's terms as the best I could, right? So I'm not done yet, okay? I'm not done yet. We have to solve for the we have to add on another layer. Okay, the total ROI with the total return on investment at the first year with inflation deduction is 64%. Then we have to add the ROI with the cost segregation tax benefit, okay, which is 87%. So how can your total return on investment goes from 54% traditionally to 64%, at 10% higher if we incorporate the $17,000, $160 of inflation-induced debt destruction, the inflation factor, right, which is 64%. Then we add on another 23% on top of that to become 87% return on investment with the cost segregation and IIDD. So how do we calculate for cost segregation? Some of you do not understand. The cost segregation we factor in is approximately $39,000 tax savings. This is a very, very subjective number, okay? How we come up, I'll explain this to you momentarily. So 30,000, how we come up with $30,000 of tax saving at the end of the first year when you do cost segregation. Cost segregation, normally okay, I'm not a tax advisor, right? So please consult a licensed tax advisor because this is my disclaimer, if you will. So a cost segregation, normally if you do not do a cost segregation, your property, according to the IRS, the tax code, allow you to depreciate on paper. It's a phantom write-off, right? Depreciate your property over 27 and a half years. So you get some, you depreciate the whole building. Okay, in this case, 1 to 4 unit is a residential investing residential, right? So instead of doing instead of depreciate $650,000 over 27 and a half years, you get some kind of small write-off per year. It's good to have it, but it's not significant. By doing a cost segregation, an engineering study, you pay a firm to do that. So what they do is they will take down the in a property. There are some items that are not permanently affixed to the building, such as the water heater, the AC, the stuff, and the landscaping and the kitchen appliances, those kind of things, right? The IRS give it a depreciation basis of like a 5-year, 7-year, and 15-year write-off, right? So cost segregation allow you to accelerate your paper depreciation losses. Okay, follow me so far? Try to understand this from a high level. I'm trying to explain to you in a layman's term. Then, furthermore, you can accelerate all using a 100% bonus depreciation, right? This 100% bonus depreciation, which came as a result of this tax bill, the big beautiful bill. Have you heard of that? That was implemented by President Trump last year in 2025. The big beautiful bill, tax reform. So you can accelerate all these 5-year, 7-year, and 15-year items and accelerate using cost segregation and to write it off all in the first year. So using a cost segregation on a property of this magnitude, $650,000, of course, you have to minus the land. The land is not depreciable. You take 20% off the land, 20% multiplied by 650 equal to whatever is the depreciation tax basis. Then I used the formula like 30%. 30% you can allocate to accelerate into the first year using 100% bonus depreciation. So 30% multiplied by whatever the depreciable basis, let's say 500,000. So 650, yeah, around $500,000. So you talk about $150,000 of a acceleration tax depreciation write-off. You can offset against either your passive income or your active income. So I don't know your individual tax status situation, but our software pretty much give you around $39,000 of cost segregation estimation write-off. Okay, everybody's tax situation is very, very different. Consult your tax advisor accordingly. So therefore, for the purpose of this illustration, for the purpose of this presentation, let's use this arbitrary number, $39,000 tax write-off using cost segregation at the end of the first year. So it will add up to all the calculation. You put, your annual net cash flow plus principal reduction plus cost savings, cost segregation 39,000 plus inflation-induced debt destruction plus your at the end of the first year appreciation at 5% on paper. So you add all that up and divide it by your down payment 171,000 equals a true ROI of 87%. On paper, based on these metrics, 87%. So most of your down payment of $171,000 in this case is offset, is a wash. So you can make a technical argument that by taking a chance, do your analyzation, if you decide to go into buy this co-living investment model, this particular duplex in mind, you get an 87% ROI at the end of the first year. So if you do not buy this kind of property, guess what happened? You miss out. There's a missed opportunity. There's an opportunity loss. If you have $171,000 sitting somewhere in a checking account, in a savings account, earning you 1%, and either way, by inflation, you lost the economic benefit because you did not take action. A lot of people these days, they don't know how to calculate. They don't know how to do the numbers. They were missing out. This property could have been, if you did this, you could be a happy camper if all my numbers are correct, or in approximation correct, not precise. This is just a pro forma. This is just an illustration. It's not reality, I mean, there's a lot of factors that plays into how you calculate the real return. So, but at the end of the day, you almost recoup your initial money back, okay? At the end of the first year, 87% return, okay? And you bought yourself an income-producing duplex, earning you very high cash flow, very high numerical metrics, higher than any traditional rental, any Airbnb, any midterm rental, any other real estate asset class out there, in my opinion. Nothing. Can you compare anything similar to this? No. We'll only talk about the end of the first year. What, second, third, fourth, and fifth year, and 10th year of ownership. You know what's going to happen for the next 5 to 10 years? If you play your cards correct, by the way, this is a long-term investment, right? We're not talking about fix and flip. This is a long-term buy and hold. Over time, year over year, your rent going to go up due to inflation, right? And your appreciation going to go up. I mean, although there are some years where there's no appreciation, that's fine. Even though there's no appreciation, your total ROI is not going to be that much reduced, right? Because your appreciation at 5% is only a small percentage of the overall of the 87%, right? So as long as you keep getting the cash flow, you operate your business correctly, you rely on Pass Split as a marketing platform, you rely on co-living property management, it's a hands-off. You don't need a second job to do it. It's a hands-off investment. It's just it's almost passive. You can scale your portfolio tremendously over the next few years and still not needing to trade time for dollar, right? You can scale your portfolio very, very efficiently without needing a second job. You spend a couple of hours per month in managing your portfolio from long distance, okay? From long distance. You buy remote, you buy long distance, you buy turnkey 100%. We have all our teams available. Every property management, our team on the ground, we vetted all the locations that we're in. In addition to Jacksonville, Florida, we have other locations of new construction co-living, the fastest real estate asset class in the world, for that matter. All right, so this is the picture. I know I have taken too long, but you need to understand this is the big picture. You need to go over the numbers. Once you understand, once you you really replay this video again on your own time, digest what I'm saying. I'm teaching you the thing that I just taught you in the past 30 minutes or so. It can help you to become a much better investor. It'll inspire you. It'll motivate you. If you have the capital, if to do this, right? If you have down payment, $171,000 down payment, is nothing to sneeze at, right? So, but some of you have the money, you have the motivation, you have the goals and objectives. This kind of co-living property is in alignment, aligned with your goals and objectives. And then who's to say you shouldn't pull the trigger, because the future is very, very bright with this asset class, right? And all right, so that's all I have to say. Hope you receive a lot of value from this video. If you have, please like and subscribe to this my YouTube channel. And also, if you have not done so already, please put your email on my newsletter database on my website below you, so you can become a free member of our real estate network, the Yee Real Estate Network. We become a free member of our network of several thousand of like-minded real estate investors out there. Then you will, few times on a weekly basis in the morning, you will receive in your email inbox a lot of great free content around real estate investing, all the strategies, housing market, the whole 9 yards, so you can make a informed decision. Other than that, if you're really motivated, if you feel you want to do this quickly, you can do a complimentary consultation. You can contact me. My number is below. We can do a complimentary consultation by phone, by FaceTime, by Zoom video, whatever it takes, so we can go over your goals and your objectives, your motivation, and what you want real estate to do for you. What's your goal? What's your financial freedom lifestyle, your goals, if you're able to achieve with this kind of real estate. Okay, thank you so much, and have a nice day. I'll see you next time. Bye-bye.